Time now for today's Market Movers with easy-to-follow futures and options trades from CME Group.
Welcome to a very special edition of Market Movers. I'm Jim Urio, and I'm here with Scott Martin. Now, on a weekly basis, Market Movers tries to provide market insight, analysis, and specific trade examples to help gauge current market conditions. But something Scott and I are going to start doing is review a trade example from the previous month and discuss how it performed in the market. Now, Scott, looking back at April, what were the biggest drivers of the market first off?
Well, it was volatility, number one,
amen,
and earnings, number two. And it was a lot of other expectations that I believe, Jim, the market kind of had with respect to geopolitical concerns, too, that maybe worked themselves out and maybe didn't, but certainly pushed around the ES and NQs.
See, I still think that pivot to higher rates is the overarching driver of the stock market right now.
It could be. Now, but you know as well as I do, the fun part is, during the day, there are many things that come out over the course of many days that are attributable to a move in the ES or NQs, and I think April was no different.
No doubt about it. Okay, so let's talk about your trade and let's break it down.
Yeah, so
first, why'd you put it out?
Well, we went into earnings season. This is roughly the trade on 4/18, and we went into earnings season with a pretty sanguine market. I felt like, especially in the NQs, looking at how we were going to get all excited about some of the fangs and the reporting that was coming out. I had a lot of longs, too, outside of, say, the futures market that were in the NASDAQ. So I wanted to have a little bit of a hedge on, plus the fact that we had kind of got a little preview of coming attractions when we saw the financials report early in April, and they got smoked after a quick bounce.
Quick bounce and then down. That was very consistent.
Yeah. So to me, it felt a little bit more reasonable to, say, have maybe a little bit of a hedge on via a put spread in the NQ.
Oh, so thinking that the fangs would do the same thing.
That's
when they
right.
report, go higher and then bust.
At least trying to protect or hedge out some of the long NASDAQ positions I had in, say, the common stock. So specifically, Jim, I put on a 6,600, 6,550 NQ put spread. It expired May 4th. Now, it cost about $140 to put on. The risk max reward was about $860 on it, so your risk was $140 to put on. Here's the key point. I didn't have to hold it until May 4th because what ended up happening was the NQs traded down off of those FANG earnings and some of the other NASDAQ earnings that came out, and I actually took the put spread off because it filled out completely. Yes, I sacrificed a little profit by doing that, but seeing as it had filled out to a level where I was comfortable saying, hey, you know what, I think the NASDAQ's going to bounce from here, I was happy to take that protection off, and it worked out because the NASDAQ bounced right back up as it led into May.
I recall. So do you consider this trade a hedge against your portfolio? You kind of alluded to that.
First and foremost, yes, because I was looking at how I was positioned outside of, say, some of the futures positions I was looking at, and I felt like given that risk reward and where the market was positioned going into earnings, it seemed like a way to look at things
So the lesson here is?
The lesson here is you can hedge yourself by putting on put spreads as long as, say, versus long positions, as long as you manage that trade, though, as well. If I would have held it into the 4th, it would have expired worthless. The May 4th expiry would have got me.
Okay, so now my trade was something different, and it required some risk managing of the trade as it came into expiration. On April 4th, I talked about selling the week to April 2570, 2560 put spread, and then in turn buying same expiration week to April 2650, 2660 call spread. Paid 2.5 ticks for that, or $125. Okay, so on April 13th, the market was right in the middle of that call spread. So when we put it on, the market was about 40 ticks below that lower strike. The lower strike was 26.50. It was trading about 26.10. So now on that day, the market's bouncing around in between the call spread. Now the worry here is that the market settles in between the call spread. You're assigned on the call that you're long and not on the one that you're short, and all of a sudden you're long the market. So I always try to take off about an hour before the expiration. At 2 o'clock Chicago time, took it off for a profit of 6 ticks, which was only 10 ticks wide, but the market settled at 57.25. So the full valuation of the trade would have been 7.25 ticks.
To avoid having what? The position.
To avoid having the position.
Yeah.
It's paid 2.5 ticks, took it off for 6 ticks, so a profit of 3.5 ticks.
Okay.
But then make sure I took it off before so I didn't get assigned. Thoughts?
I think that makes sense. And I mean, here's the funny thing. I remember that trade well. And at the time, I mean, it was obviously a play on some volatility that was still out there.
Sure.
Now, what's funny about that, though, is if you look at how that trade progressed throughout the month, volatility started dropping. I mean, we talked about it today, and now volatility is pretty pretty much nowhere to be seen. I mean,
Yeah.
it's basically below the
Right.
floor here. So the reality is similar to maybe my expression was, you need to make sure that just because you put on a position based on a current expectation of something, things change a lot in today's
Oh, no
market.
doubt.
So you have to
No
be
doubt.
ready to kind of manage that risk a little bit as the trade progresses towards expiration.
But what I learned there, and this is just hammering home a lesson I've learned time and time again, is you must manage these positions going into expiration, because a lot can happen in that last hour of trading. And the last thing you wanted to do is think you put on a low risk trade, and then all of a sudden you have a high risk trade because you got a sign.
Agreed.
Now, well, thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.